Hello, welcome to the Joe DeLisi Financial Advisor Podcast. I'm Joe DeLisi. Today is April 4th, Friday, April 4th, and we are in the middle of the second day of a big market sell-off, global market sell-off. Our topic today is tariffs, and I give you the date. Probably should give you the time, too. It's the morning, because the truth is, by the time this podcast gets compliance approved and published, crossing our fingers, maybe the market comes back a little bit. So who knows? It just, everything happens so quickly that when you record a podcast like this, it could be old news by the time you even get it out there. So based on that, the world, it's complex. The only thing that's certain really is change itself. And so it stands to reason that any kind of like real odd change or an event like this that shakes up what we thought was going to happen, it's going to impact markets and perhaps in a negative way like we're seeing. And then if you add to that political persuasions that deeply impact our feelings as to why markets are doing what they're doing, we got a real potential recipe for disaster. So I want to say this to start with. I've seen so many things in the press. Everyone is an overnight tariff expert. I am not. Everyone is an automatic, PhD level historian. I am not. What I do know is this is a different formula, right? The president, the current administration has put forth that they want, obviously, to do these tariffs. He's been unapologetically telling us that was going to happen. President Trump wants big tax cuts. They want government reduction. They want spending reduction. A lot of things going on at the same time. So, the markets are looking at this as saying, wow, we've never seen all of this happen in such a short period of time. And so when you have other countries, for instance, today, China, retaliate with more tariffs, it's going to spook markets. That's not really a surprise. So let's get into some of these numbers because, I've been fortunate enough really to advise you guys, my clients, across 6 different presidential administrations. Actually, it's technically, I guess, 5, but because President Trump's terms were non-consecutive, I count them as 2 different administrations. And by that count, I've been around 3 Democrat presidents and 3 Republican presidents. And I can tell you one thing for sure. At any given time, half my clients are upset with who is president. And there were times in the last 4 years that I had to dig into a lot of math and a lot of statistics just to keep my Republican clients invested. And I did the same with the prior 4 presidents as well. I had to keep my Democrat clients invested. Many people, again, along the lines of political persuasions as to how they feel about the markets and how they move. And I felt like I was always talking my clients back into the market. But I can't just do that with stories. And I think that happens far too often. I feel like the advisory space generally will tell you, stay the course. It will generally tell you, you're going to be fine in the long term, and they'll come up with stories. And look, that's fine. But sometimes we need data. So I'm going to warn you again ahead of time. I think the last podcast was pretty heavy in data as well, maybe 2 prior. But we're going to be a little heavy in data. This is going to go a little longer than normal. But I feel like I really need to get into some data. So you have some context as to why I'm saying the things I say and why I feel the way I feel about what's going on in the market. Because it has nothing to do with a political persuasion. It has nothing to do with emotion. Really, everything with me when it comes to financial advising in general and wealth management specifically, it's got to be based in evidence. It's got to be based in data. That's all we have. So for this reason, we're going to address the tariff issue, again, being pushed unapologetically by the president, and it's spooking markets. Now, I will say it's early. It's not early in terms of the news that tariffs were going to be placed. We knew that was coming. We knew that during the election season. But the amount of tariffs, the level of tariffs, we're basically 2 or 3 days into that. And so the market's movement is early as of recording this podcast, again, Friday, April 4th. So my job is really, it's part historian, part mathematician. And I wanted to look back over the various other times that tariffs were levied and just see, how did various markets react? Again, not all these time periods are going to be the same. There's some similarities, and it's difficult too, because if you look at 100 years ago into the 1930s, it's very difficult to project that forward to today or vice versa. It's just hard to do, but it's all we have. So the purpose here isn't to predict anything, right? But I just want to see how has history behaved. And here's what I found. And I'm going to go a little bit off of what I normally do here. I really want to move into I'm going to read off of notes because I think that helps a lot. So every now and then I'll be, if you're looking on video, we're going to be looking at some notes to the side. Some of it I have in my head and some I don't. In an analysis of the performance of the S&P 500, the Russell 2000, and MSCI World Index during significant tariff years from 1930 to recent dates, these are the times I found, the time periods I found. We have 1930, 1971, then we have 1981 through 1988, long time. We had 2002, we had 2018 and 2019, and then we had 2024, and of course 2025. I didn't even know about the 2024 tariffs that were placed. And exact daily or monthly performance data for all of these indices I'm looking at, it's not really fully available across the entire historical span because of the different inception dates. So like the MSCI World Index starts in 1969. The Russell 2000 started in 1978. So I'm going to provide annual performance where the data exists, and I'll substitute in or add in other indices where appropriate. Like when years predating an index's existence. I'll note its absence if it just didn't exist at all, or I'll use the proxy data, and I'll try to tell you when I'm doing that. So let's go back to 1930. This one, I will tell you flat out, this one's annoying to me because I'm seeing a lot of my colleagues on social media, emails, all sorts of communication where they're referencing Smoot-Hawley tariffs. They're referencing the end of Bretton Woods, which we'll mention in here. But they're not just referencing it like as a noting the time period. They're actually speaking to it. And I got to tell you, I know some of these people, and I don't think that they have, master's level or PhD level degrees in macroeconomics or global policy. I mean, they might. I don't know, but I don't think they do. But they're speaking like they do. I don't want to do that to you. That's not who I am. I am your financial advisor. My job is to give you context, give you evidence, and basically keep you on the path to building your wealth. Because at the end of the day, I have to throw this in here because it's really important. The purpose of your money isn't to beat your neighbor. It's not to beat a market. The purpose of your money is to fully fund the financial plan that you designed that carries all of your hopes and all of your dreams. And we rarely are going to, if ever, put in a rate of return that's like, 10, 12, 15, 20, 25% linear rates of return. We don't need that. If you work with me, most of our rates of return that we're using to fully fund your financial plan or the hopes of fully funding your financial plan, we're talking about 6, 7, 8% rates of return, right? So my job isn't to become a global economic, PhD level professor. My job is to give you some context, okay? And that's all we're going to do here. So now back, with all that being said, let's go back to 1930, which was the Smoot-Hawley tariff. Here's what happened. The S&P 500, which actually, and this is, I didn't even know this. I had to go pull it up and make sure that I was right. It wasn't called the S&P 500. That makes sense. It was called the S&P 90 because it was the predecessor to the modern day S&P 500, which, by the way, only expanded to 500 companies in 1957. So the S&P 90 did exist in 1930, and that index fell sharply. It had a total return of approximately negative 25% for the year in 1930, which would reflect the onset of the Great Depression, which was worsened by the tariffs disruption of global trade. And there was some other stuff going on there too. The Federal Reserve actually tightened money supply, so it took money out of the economy. So there's some stuff going on there. It wasn't just a tariff issue. But notwithstanding, the S&P 90, or we would, reference as the S&P 500 today, down 25%. Ouch. Now, small caps. What I'm using here is the Fama French from University of Chicago, the small cap index, because we didn't have the Russell 2000 back then. That was down 38%. Another ouch. MSCI World didn't exist. That didn't actually exist until 1969. So global markets were broadly negative. We know that. Due to the depression, but no real specific index data is available, so we'll just exclude that for now. Let's move on to 1971. So 1971, this was President Nixon's 10% import surcharge. It's a tariff. The S&P 500 posted a total return, are you ready for this, of positive 14.3%, despite the tariff. Now, it was a temporary tariff. And that brings up a really interesting point here. We don't know, the current president has not been clear as to how long these tariffs will exist. He has publicly said that he will negotiate with countries, up and down. And so we don't know. Like, this could be look, I have no clue. I predict nothing. I don't know if this is going to be an 8-year tariff, 4-year tariff, 8-day tariff, situation. I have no clue. I can tell you the Nixon tariff was relatively temporary, and the S&P did just fine. It had, again, a total return of plus 14%. How did small caps do? The Fama French index was up 21%. MSCI, again, didn't exist yet, a little early for it. But, global markets were affected by the end of this, where we reference the Bretton Woods system. But no comprehensive index data is available for the global stocks yet. And I should also mention, why are we even talking about indices or stocks that aren't the S&P? And it's because, well, you're probably my client, or maybe you're another financial advisor that follows me and listens to this. And what you know is that, look, we don't invest just in the United States. We invest globally. And so I need to look at not just domestic returns. I need to look at global returns where available. And also we tilt. We tilt very heavily to small cap companies. We tilt to micro cap companies here in the U.S. We tilt to small and value, not just here in the U.S., but also internationally, right? So we have to look at the way that these different stocks have performed to give us, again, just some context. We're not predicting anything. I just want to see, how did it occur? What went on when we had tariffs before? Because it's scary when it's occurring in real time. Now we got a long one. So now we're going to talk about 1981 through 1988. Now these are the Reagan tariffs. This was interesting to me just because I had family who used to work for Harley Davidson. Apparently there's a big motorcycle tariff in 1983, and it had a lot to do with Harley Davidson and the Japanese making motorcycles. And so that was kind of inside all that. It has nothing really to do with it, except it's just interesting to me. So how did we do? In 1981, the S&P 500 is down about 5%. So we had a recession. If you remember, if you've been around long enough, if you remember back to the early Reagan years, right when he was elected, we went right into a recession, and we had very high interest rates, from the late 70s. So yeah, we had a negative 5% rate of return. Honestly, not too bad when you consider we had a recession, high interest rates, all that kind of stuff going on, tariffs, and negative 5%, really not the end of the world. As of recording of this podcast today, the S&P 500 was down 5% when I last looked at my phone, Friday, April 4th in the morning. So 5% for the year, not too bad. 1983, S&P was up 23%. So we had recovery, obviously. We had tariff protection for very specific industries, again, like the motorcycles. And so we had some recovery there. And 1988, by the end of this, so, a long time period we had these different tariffs, 1988, up about 17%. Very strong economic expansion in the U.S. economy. So overall, the S&P 500 during that time period, it saw a mix of declines and strong gains, but it averaged about 11% annually over the decade. And I have to just throw this out there. That is including 1987, when this is the Dow, when we had the flash crash. Anybody remembers that? That was... it was scary. That was, I didn't live through that as an advisor, but incredibly scary. And even in light of all that, we're up 11% annually in the S&P 500. Okay, how did small stocks do? So now we can use the Russell 2000. In 1981, small stocks were up 5%, actually 5.2. So if you remember, the S&P was down about, the S&P was down, 5%. It was down 4.9. So in 1981, the S&P is down 4.9. Small caps are up 5.2. 1983, up 29%, whereas the S&P was up 22. Small caps now are up 29%. In 1988, plus 22%. The S&P was up 16. So small caps generally really outperformed large caps during this specific period of economic volatility and recovery. Small caps, specifically growth stocks, averaged about 15% annually from 1979 through the end of 1988. And actually, if we go a little deeper, because that's small value or that's small growth, if we look at small value, and I'm using the Fama French small cap value index for this, those returned 22%. So very, very solid growth. And again, speaking to why we diversify, right? We're not just looking for large cap growth US, we're looking for small cap growth, we're looking for small cap value, we're looking for large cap value, we're looking for international and all those different indices as well. So that's why we do it, because we don't know what's going to recover. We don't know what's going to hold. We don't know what's going to save us, in periods of red ink everywhere. How did international do? And I told you, I warned you ahead of time, right? This is going to be heavy data. But it's important to have the data so that when we speak, if you're my client and I'm like, listen, I don't know how this is going to work short term. It could be really ugly. But I'm fairly confident that, capitalism isn't going to fall. And assuming the world doesn't end, I think we're going to be okay. And this is why I'm saying it, right? Because these returns really aren't bad. So how did international do? We already talked about how small cap did really well. We looked at S&P. Large cap growth didn't do so well. They were down almost 5%. International stocks, international large cap in 1981, they were down about 4%. There was a global recession, just like here in the US, we had a recession here. 1983, they were up 23%. Wonderful global recovery there. 88, they were up 23%. Very, very strong gains. So the MSCI World international stocks averaged about 10 to 12% annually, depending on what we're looking at exactly. And it's just reflecting U.S.-led growth. Honestly, the other thing that happened there was the Japanese economic crisis. So once again, international value stocks were even higher at about 27%. And that comes from, again, the Fama French International Small Cap Value Index. Why am I using Fama French? Generally speaking, we can't get any data for anything that has a value stock, unless we use that University of Chicago data. That's why I'm using it. You may not see a lot of that out there in the media. I don't know why they don't use it, but they don't. But because your portfolios are tilted very heavily to value, we track that index. I mean, it's one of the things that I'm looking at, both internationally and domestic. Okay, more recent. So now I am an advisor. This is the time period of my advisory life. I remember these things. 2002. This was the Bush steel tariffs, which most people forget about. So the S&P had a total return in 2002 of negative 22%. Yikes. And that's driven by the dot-com bust aftermath, a very weak economy. That's all despite tariffs aimed at protecting steelmakers. We still had a huge drop in S&P return. Russell 2000, so small cap growth stocks, returned almost as bad, negative 20%. So not much better, slightly less negative. Small caps did show relative resilience, and small cap value stocks, actually, small cap value was only down 9%, according to that Fama French index. So if you're looking at it and you look back in time, whereas if you've got the S&P down 22, but at the end of that year, small cap value was only down 9. If you were diversified, yeah, you were down, but you weren't down 22, right? That's the purpose of diversification. Now, when things are dropping quickly, like we've seen the past 2 days at the recording of this podcast, diversification doesn't really matter over 2 days, right? Everything drops. Everything's scary. Everything's bad. As it starts to shake out is when you see diversification really play, not just domestically in the different markets, but also internationally, and then fixed income, right? Fixed income, obviously, high quality short fixed income is pretty non-correlated to stocks. That's why we own it. Back to 2002. What about the MSCI World? What about international stocks? Well, it was down about 20, 19.9. So it was just as bad as the S&P for my dollar. Now we're going to fast forward to 2018. 2018, we had not my term, but the media's term, the Trump trade war tariffs. I mean, this was scary. If you probably don't remember it because it happened so quickly, but I remember it. I remember when President Trump came into office in 2016 and he started to tariff China in particular. People were predicting a global trade war. Everything was going to be a disaster. And it was a scary time too. The reason why you probably don't remember it is the S&P in 2018 was down about 4%. And there was a lot of volatility that year, right? A lot of ups, a lot of downs, but overall down 4. Here's why you don't remember it. 2019, the S&P did a tidy 31.5% rate of return. So pretty strong rebound, right? We had the Fed easing money supply. We had a lot of trade deal optimism. I mean, look, this is just changing tariff direction depending on what other countries do. That's what happened in 2018 and 2019 with the first Trump administration. So how do small caps do? 2018, they were down 11. So much more, almost 3 times as high in this time period as the S&P. 2019, they were up about 26%, lagging the S&P a little bit, but strong recovery. International was down about 9 in 2018. It was up almost 30% in 2019. So for people who beat up international, which a lot of people have been, you got to look at that recovery in 2019 and say, wow, in a time period of trade war fears and tariffs that we hadn't seen in a very long time, international had a ridiculously strong recovery when nobody was really talking about that. So keep that in the back of your mind. Again, not predicting anything, just telling you the history. Now, this is the one that caught me off guard, 2024. I had no idea this occurred. President Biden put some Chinese tariffs in play. I didn't even know that. It wasn't really reported. The S&P 500 did a total return of about 28%. And, you know, like that, we had tech strength. We had a strong economy. We had very strong returns despite the tariffs. Russell 2000, small caps, total return of about 10. Underperforming large caps, you know, you can't look at 1 year and say, oh, and for that reason, we're not going to own them. The recovery of small caps and international is well documented in history if we look back in tariffs over the other time periods. What about international? International actually had a return of about 15%. So international large cap stocks actually did better than U.S. small cap. So what did we learn? Like, let's wrap this up a little bit so that I can, you know, stop the recording of this podcast and go look at what the markets are doing so I can, you know, talk to you if you're worried. What did we learn? The Great Depression tariff was, I mean, it was a Great Depression. I include it because it's what I've seen, honestly, the media look at the most. I see everybody talking about it. And I'm not downplaying it. I'm not, for the 1,000th time, I'm not predicting anything here. But I'm not sure taking a 100-year-old event and using only that as our guide makes sense in light of modern trading markets mechanisms in relative of the current policy of the administration. Everything's just different. Even the Fed policy is different. Aside from that time period, though, markets across the globe, they perform pretty well despite tariffs. 2002 stands out as a bad time, but really, if you think back, that was at the end of a tech bubble. It was at the end of a recession. We had the greatest terror attack in U.S. history. So it's a really weird time period. And every other time looked pretty good if you could get through the short-term early volatility. Another item of note, small stocks and particularly value stocks, they seem to do quite well, as did international stocks. So what? What are we going to do? Well, if you're my client, the equity portion of your portfolio is almost evenly divided between U.S. and international stocks. And as we've said, we tilt towards both small and value, both here and in the U.S. and across the globe. So no matter if it's a Democrat or a Republican at the helm, let's just continue to let the markets do the work for us. Right? In 2028, we're going to have another president. It's going to be a Republican. It's going to be a Democrat. Half of you are going to be happy. Half of you are going to be upset. To me, it doesn't matter. Let's just let the markets continue to do the work for us. They, time and time again, if we've stayed, we've been okay. You have any fear out there? Probably some of you do, right? Emotions run high. This is your money fully funding your plans and your hopes and your dreams. Like, you should be emotional. I don't fault you. So if you've got some fear about these tariffs or the policy or what you think is going to happen or anything else for that reason, just give me a call. My job is to worry for you and to do the research for you because you don't have the time for that. You've got work, you've got family, you've got, you know, life. This is what I do. Let me worry for you. Let me do the research and be sure that we're still in good shape. And guess what's next? Compliance. Registered representative, financial advisor, Park Avenue Securities, LLC, pass OSJ 5280 Carroll Canyon Road, Suite 300, San Diego, California, 92121, 619-684-6400. Securities products and advisory services offered through pass member FINRA, SIPC, financial representative, the Guardian Life Insurance Company of America, Guardian, New York, New York. Pass is a wholly owned subsidiary of Guardian Westpac Wealth Partners, LLC is not an affiliate or subsidiary of Passive Guardian. Insurance products offered through Westpac Wealth Partners Insurance Services, LLC, a DBA of Westpac Wealth Partners, LLC, California Insurance License Number OD34103. This podcast is for informational purposes only and is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only when coordinated in individual professional advice. Guest speakers and their firms are not affiliated with or endorsed by Pass, Guardian, Westpac Wealth, and opinions stated are their own. Guardian and subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. Diversification does not guarantee profit or protect against market loss. Equities may decline in value due to both real and perceived general market, economic, industry conditions. This material is intended for general use. By providing this content, Park Avenue Securities LLC and your financial representative are not undertaking to provide investment advice or make a recommendation for a specific individual or situation, or to otherwise act in a fiduciary capacity. Past performance is not a guarantee of future results. Indices are unmanaged, and one cannot invest directly in an index. 7733329.1 expires March 2027.